As of May 2021, the consumer debt in North America was around $15 trillion. Go ahead and gasp. We did. Debt is not something any of us want. Yet in life, we need to purchase high-dollar items like a home or a car. And since we aren't all born with the proverbial silver spoon, we take out loans from banks and other lending institutions. In addition, we often use credit cards to pay for day-to-day expenses, and sometimes balances are maintained on those cards. Couple the hefty interest rates that accompany loans and credit card balances with our ability to save and invest, and it becomes a sometimes futile juggling act. We've asked this before, and we'll ask it again. What would it mean for you to have the ability to buy a car, a home, or pay for your child's education without applying for a loan with tons of paperwork and exorbitant interest rates? These very thoughts are how the infinite banking concept was derived by the great R. Nelson Nash back in the 1980s. R. Nelson Nash said, "The very first principle that must be understood is that you finance everything you buy. You either pay interest to someone else or give up the interest you could have earned otherwise." For those unfamiliar with the late Nelson Nash, he was the author of the popular book Becoming Your Own Banker, the creator of the infinite banking concept, and the man behind the Nelson Nash Institute. In the early 1980s, Nelson had many loans with banks, and he struggled to pay the high interest rates. Based on his education and being a loyal follower of the Austrian School of Economics, he developed a way to avoid high interest rates and become financially independent. How did Nash do it? You guessed it, he used participating, dividend-paying, whole life insurance policies. He decided to share his method and created a concept called infinite banking. His institute, by the same name, teaches individuals and companies how to unleash themselves from the high cost of traditional bank loans and how to be their own bankers through participating, dividend-paying whole life insurance. We recently watched a video interview of Nelson and his son-in-law, who now heads his institute, where they told a story about their first meeting. His son-in-law, David Stearns, and Nelson met many years ago at David's wedding to Nelson's daughter. David was in the service in Hawaii, and the Nash family flew out for the wedding. But before Nelson headed home, he handed David an insurance policy to sign. David laughed at the memory because his younger self had just signed it and didn't think about it or question it. But that very policy gave David and his wife the down payment money for a new home years later when they had 4 kids and needed to upgrade. In fact, the video says that the entire Nash clan doesn't have one bank or financing loan for any of their houses, cars, or kids' educations. Instead, their lives are all funded by many par whole life policies. Nelson didn't just talk about the benefits of this financial tool. He lived it, and his family is still living it today. Nelson has said that IBC isn't difficult to grasp, and it isn't a plan, it's a lifestyle. It's not a one-and-done situation, but a mindset that will revolutionize how you fund your life's purchases and save for the future. This same belief is the backbone of our product, process, and philosophy called Child Millionaire, which, as you know, combines time, compounding, and the infinite banking concept of using par whole life to accumulate capital for every generation. So what does Nelson mean by his book title? How does anyone become their own banker? As we've explained in the previous chapter, when you take out a par whole life insurance policy, you pay a premium, which builds equity in the policy. The unique feature of par whole life is that in addition to the death benefit provided, there is a provision made for the policy owner to own the death benefit. This provision, guaranteed by the legally binding contract, prevents the value of the par whole life insurance policy from being eroded by low interest rates and the ever-increasing cost of insurance, to which typical term and universal life insurance contracts are subject. The portion of the death benefit, which becomes the personal property of the policyholder, is called paid-up insurance. As paid-up insurance is a legal asset belonging to the policyholder, it is no longer merely a number promised by the insurance carrier and can be used as cash equivalent by withdrawing that value from the policy or using that value as collateral for a loan.